Welcome to The Explainer. Today, we're diving deep into the psychology and the hard data behind our massive shift to digital money. We are literally living through a fundamental restructuring of how human beings exchange value. But think about it. Why do we actually choose to use a specific app over those crinkled bills right there in our pockets? What makes us trust a scattered pattern of pixels in a QR code over a piece of government-backed paper? Well, today we are unpacking the cashless satisfaction mystery, and we're going to start with a question about your own wallet. Here is our roadmap for today. 1. The cashless revolution. 2. The science of adoption. 3. The 5 factors of satisfaction. 4. Testing the theories. And finally, number 5. The real drivers. Let's get right into it. Section 1. The cashless revolution. To kick things off, we really need to understand this massive global shift from paper money to digital taps. And look, this isn't just some minor update to your banking app. It's a structural shift in the global economy. So I want you to think about this personally for a second. When was the absolute last time you actually handed over a physical banknote to buy something? Seriously, take a moment and think about it. For a lot of us, it's getting harder and harder to remember, right? And that simple question highlights just how lightning fast physical cash is becoming obsolete in our daily lives. Think about the emotional weight of that shift, too. For centuries, money has historically been something we could touch, fold, and hold in our hands. Making this invisible digital leap is actually a profound psychological shift. E-finance has officially moved from a neat little convenience to a totally mainstream expectation. Now, places like the Kathmandu Valley have become incredible epicenters for this digital finance boom. Just look at Nepal. Because the population is so geographically dispersed, building traditional physical bank branches in remote Himalayan villages just isn't feasible. It's way too expensive. So mobile networks essentially became the vital infrastructure for finance. The government and the central bank made digitization a core pillar of their whole strategy. And the results are wild. We're seeing explosive growth in mobile banking, QR codes, digital wallets like eSewa and Kalti, and interbank platforms like Connect IPS. And of course, this trend spread like wildfire during the COVID-19 pandemic, when everyone, consumers and merchants alike, was desperately searching for contactless ways to pay. But here's the thing. Just having the technology available is only half the battle. Which brings us to Section 2, the science of adoption. Because, as you know, simply building a cool app doesn't mean anyone is actually going to use it. We need to uncover the psychological theories that explain why we adopt these new technologies in the first place. And that's where the Technology Acceptance Model, or TAM, comes in. This is basically the foundational lens researchers use to predict whether you are going to download and actually use a new payment app. It really boils down to 2 vital questions. First, perceived usefulness. Basically, does this app actually make my life faster or better? And second, perceived ease of use. Is this thing straightforward to operate, or is it going to give me a massive headache? Let's look at a micro example here. If an app lets you pay your utility bill in 1 second flat, it has incredibly high perceived usefulness. But if that exact same app requires a totally convoluted 20-step password reset every single time you log in, well, its perceived ease of use is terrible, and adoption will stall dead in its tracks. If a cashless system fails on either of these 2 fronts, it literally will not survive. Now, while TAM is the dominant theory, researchers often compare it with other frameworks to get a much fuller picture. One of those is the Unified Theory of Acceptance and Use of Technology, or UTAUT, which expands the scope significantly. It acknowledges that, hey, it's not just about the app itself. UTAUT brings in social influence, meaning are your friends, your family, and your local coffee shop actually using it? It also adds facilitating conditions. Let's make that academic term a bit more tangible. Facilitating conditions basically mean having things like a reliable 4G connection when you're standing at the checkout counter, or having a smartphone battery that doesn't die by noon. By comparing these models directly, researchers cast a wider net to capture exactly how social pressures and everyday environmental realities shape our habits. Moving right along to Section 3, the 5 factors of satisfaction. Because getting someone to adopt an app is one thing, but long-term satisfaction is what actually keeps that app on your home screen. So let's lay out the specific blueprint of variables that researchers identified to test consumer happiness. We've got perceived usefulness and perceived ease of use, right? Those are straight from our TAM model. But we are also adding security and trust, social influence, and convenience and accessibility. Think about how these 5 specific factors interact out in the real world. Every time you tap your phone, that transaction passes through all 5 of these filters in your brain in mere milliseconds. You might find an app incredibly easy to use, but if you don't actually trust it with your bank details, that convenience is totally useless. Or maybe it's built like a digital fortress and highly secure, but literally none of your local shops accept it, meaning it completely fails the accessibility test. These 5 factors interlock, and they represent the absolute battleground for fintech companies who are trying to win your loyalty. So, how do we know this works? Section 4. Testing the theories. It is time to put these theories to the test by diving into some hard empirical data. We are moving from the realm of theory to reality, looking at a really comprehensive study of 348 digital payment users over in Bangladesh. And when we look at the demographic breakdown of this study, a super fascinating picture emerges. Out of all the valid responses, a massive 57.47% are students. In fact, over 54% of the total respondents were between 18 and 25 years old. Now, you might be wondering, why do students drive so much of this demand? Well, younger users typically have far fewer entrenched habits with legacy banks. They possess a much higher tolerance for testing out new tech, which makes them the ultimate litmus test for user experience. They are the early adopters who are out there pushing the absolute limits of these digital systems. Now, I want you to focus on this massive number for a second, 77.2%. In statistical terms, this is the R-square value from the study's regression model. But what does that actually mean in plain English? It means an incredible 77.2% of a customer's overall satisfaction is explained by just those few key variables tested in this model. Now, if you know anything about social science or consumer behavior, you know that human actions are notoriously hard to predict. We are messy. So being able to explain nearly 80% of why someone actually likes a product is a massive, massive success. It means the researchers essentially unlocked the puzzle and found the precise levers that control user happiness. Let's see what those levers actually are in Section 5, the real drivers. So, the researchers went in with several hypotheses to see what would survive the statistical gauntlet. Let's look at the showdown. Hypothesis 1 proposed that just having high customer awareness, basically just knowing about the app, would significantly drive satisfaction. Well, that was statistically rejected. It had a p-value of 0.836. To put that into perspective, a p-value that high means there's an 83% chance that any connection between mere awareness and actual satisfaction is totally random, so it completely failed as a direct predictor. But on the flip side, hypotheses 2 and 3 were resoundingly accepted. Perceived ease of use and perceived security and trust absolutely drive satisfaction. The business takeaway here is huge, folks. Companies waste millions and millions of dollars on billboard marketing just to boost awareness, when what they really should be doing is spending that capital on app development to make sure their platform is flawlessly easy to use and lockbox secure. And the Pearson correlation math completely backs this up. For context, a perfect positive correlation would be 1.0. Here, ease of use achieved a massive 0.805 correlation. That is remarkably high for behavioral science. It was the absolute strongest predictor out of all the factors they tested. Security and trust was right behind it at 0.701. But notice the hierarchy there. Ease of use actually beat out security. People obviously care a ton about safety, but ultimately, friction is the biggest enemy of digital adoption. The message from the data is loud and clear. If you want satisfied customers, don't just tell them about your product. Make sure the buttons actually make sense, that the interface is incredibly clean, and that their money is completely protected. This brings all that dense academic data right back to the real world. As the research notes, to quote directly, to increase adoption, service providers must invest in user-friendly designs and robust security measures, while governments develop frameworks for safe, inclusive transactions. This serves as a clear data-backed warning. Massive marketing budgets won't fix a clunky app. And notice the dichotomy at play here. Private service providers must invest their capital directly into the app's design and security. Meanwhile, public governments have a mandate to build the inclusive frameworks and infrastructure that make these digital ecosystems safe for absolutely everyone, not just the tech-savvy youth in urban centers. So let's bring it back to you and reflect on your own financial habits. We've seen the data. We know that convenience, usability, and trust are the ultimate currencies in the digital age. But I want to leave you with this thought. Knowing what actually drives consumer satisfaction, what will it really take for you to completely abandon physical cash? Is the ultimate cashless future simply a matter of a bank designing a slightly better, safer app? Or is there a profound psychological threshold we have yet to cross?